Okay, well, I think we can start. So, firstly, good afternoon, everybody. Welcome to today's webinar from James Cook University, Singapore. The topic for today is the outlook for the real estate market in Asia Pacific. Again, obviously, thank you for making time. We have a very special speaker today, Mr. Niel Thassim, who I'll introduce very, very shortly. Just in terms of some housekeeping before we begin, and for those of you who don't know me, my name is Issa Nkivni. I'm a sessional lecturer here at James Cook University, Singapore. Today's webinar has been recorded for, obviously, for publicity purposes. And I think, as Erica has mentioned, you're able to ask questions at any point of the webinar using the Q&A function at the bottom of your screen. We will take Q&A at the end of the presentation. There'll also be a satisfaction poll and a survey at the end of the webinar, just to ensure that you got what you were looking for from the webinar. Naturally, if there's any technical issues, you can please use the chat button to communicate with the event organizers who can assist you with any issues. Very briefly, we're delighted to have Mr. Niel Thassim today. He's a managing partner of the private funds, and he's the CEO of Brookfield Asset Management in Singapore. Just to sort of give a brief background, as I mentioned, he's responsible for developing, and maintaining relationships with leading investment partners in the region. Prior to his career with Brookfield Asset Management, Mr. Thassim served as the managing director and Asia Pacific head at Deutsche Bank's real estate investment business. Prior to Deutsche, he's held roles with Coopers & Lybrand, Bankers Trust, Credit Suisse, and Colonial First State. Over 25 years of finance, accounting, and real estate investment management experience, and currently he serves as a board member at the National University of Singapore Institute of Real Estate Studies and the Singapore chapter of Urban Land and Distribution. So very briefly today, we'll be having the presentation for Niel will talk for about 15 to 20 minutes in the outlook of the real estate market in Asia Pacific, and then we'll open up for Q&A after the presentation. So without further ado, Niel, it's a pleasure to have you with us today. Thank you so much for your time. Over to you to walk through your presentation, please.
Thanks very much, Eamon. Can you all hear me okay?
Yep.
Okay, perfect. Well, good afternoon, everyone. Firstly, thank you to James Cook University for arranging this webinar and inviting me to speak. Thanks to everyone on the line as well for taking the time to join us here today. As Eamon mentioned, my name is Niel Thassim. I'm a managing partner at Brookfield Asset Management here in Singapore. I've been with Brookfield for about 9 years. I've been in the real estate industry for about 25 years. 15 of those have been up here in Asia. Eamon asked me to share with you some insights on the outlook of the Asia Pacific real estate market. And there's always a little bit of a risk of overgeneralizing when talking about the Asia Pacific region, because it's by no means homogeneous across sectors and regions. And the great thing about real estate is it's lowly correlated with other asset classes, but more importantly, it's lowly correlated with itself. What drives real estate returns in student accommodation assets in Australia is very different to what drives real estate returns in logistics assets in Korea, or office assets in Shanghai, or residential assets in Singapore. But even more specific than that, individual assets by themselves are lowly correlated with each other. You can have two shopping centre assets sitting right next to each other in Shanghai, and one is generating record revenue and the other one's a ghost town. And that really comes down to how those assets are managed. And so one mistake that investors often make is assuming that real estate is homogenous, and they rely too much on top-down macro views to drive their strategies. The industry spends an enormous amount of time studying and discussing market cycles and where we are in the market and timing the market. And I'm sure you've all seen lots of broker research reports that try and predict where different sectors and cycles are in the market. But what's really important to appreciate is that real estate is just not simply a thematic allocation. They're physical assets which require really substantial operating expertise, whether that's in the form of a good hotel general manager or an office leasing team or a retail marketing team. It's the people that drive the alpha and the returns in real estate. And those investors that take a top-down asset allocation perspective to real estate oftentimes miss the point. And over the last few decades, global real estate investors have looked at the Asia-Pacific region through the lenses of fast-growing Asian economies on the one hand, and maturing and institutionalizing real estate and cap markets on the other hand. And they've leveraged those two trends to seek to generate attractive risk-adjusted returns compared to Europe and North America. And that's largely played out over the last few decades. And I believe that those two trends, the fast-growing Asian economies and the institutionalizing real estate and cap markets, will continue to underpin opportunities in the region for some time to come. But for the purpose of this talk, what I thought I would do was just focus on discussing one very significant macro trend that is impacting virtually all sectors across the region today, and then touch on three thematic trends that are really disrupting and dislocating a number of sectors in the region. But before I get started on that, and for those of you that are less familiar with Brookfield, let me just take a couple of minutes to just introduce you to the organization that I work for. So for those of you that don't know, Brookfield has been developing, owning and operating real assets for over 100 years. The company started as a Canadian business that built and operated Brazil's transportation network and power grids back in the 1890s. At the time, the company was called Brascan, which stood for Brazil, Canada. But then over the next 100 years, it grew to own and operate real assets and real asset companies all over the world. And today it manages about $600 billion of assets with over 150,000 employees globally. It focuses on a couple of areas: real estate, infrastructure, real asset related private equity, and private credit. In the Asia Pacific market, we manage about $80 billion of assets under management, with over 35,000 employees around the region. Real estate is by far our biggest business in Asia Pacific, with about $26 billion of assets, primarily based in Australia, China, India, and Korea. And then maybe just touching a little bit on our real estate business globally, Brookfield manages over $200 billion of real estate around the world, with over 25,000 real estate employees. We invest globally across all different real estate types, from office, industrial, retail, residential, hospitality, and other sectors. We invest up and down the risk spectrum, from core to opportunistic, as well as in both equity and in debt. So maybe with that, just as a bit of a backdrop, let me now dive into some market insights. And as I mentioned, what I'll do is I'll just touch on one very important macro trend that is impacting a large number of sectors across the region. And then I'll touch on three thematics that really we are focusing on a lot at the moment, because they are dislocating a number of the real estate sectors in the region. In our view, the single biggest macro driver in the Asia Pacific real estate markets today is the rise of the Chinese middle class. It is and will continue to have a more profound impact on more sectors in the region than any other trend that we are monitoring. Today it includes over 150 million households, over 400 million people, which, as you know, is more than the population of the US. And we at Brookfield are spending an enormous amount of time studying this trend, trying to understand the risks associated with this trend, how to price those risks, but more importantly, how can we take advantage of this trend to generate returns for our real estate investments in the region. And just to give you a quick taste of some of the things that we're looking at and thinking about when we consider the rise of the Chinese middle class. If we start in the domestic market, the most obvious one is the residential real estate market. As the Chinese middle class has grown, it's also migrated, obviously, from the rural areas to the cities. Now more than 60% of the population lives in cities, and approximately 70% of the urban population of China is classified as middle income. That's creating huge demand for both affordable and luxury residential stock in the cities, both in terms of build to own and build to rent. Another consequence of the population transforming into the middle class is the transition from an agricultural-based economy to a manufacturing-based economy to a service economy. A growing service, R&D and tech economy drives significant demand for modern, highly sophisticated, high-tech office stock, particularly in first and second tier cities in China. And this is providing really interesting opportunities for offshore private capital and for operators of premium grade specialist office buildings around the world to come into China and to develop, own and operate these more sophisticated office buildings in first tier cities across the country. And the final interesting observation is that when a population transitions from a low to a middle income population, their nutrition and dietary habits change. They move from a staple of wheat and barley and soy to a staple of fresh meat and fresh fish and fresh vegetables. And all this fresh produce needs to be transported from farms and ports to cities in refrigerated transportation and storage facilities. In the US, approximately 70% of all food produce is transported and stored in refrigerated facilities. That's compared to about 25% in China. So there's just an enormous need for build out of cold storage facilities across the transportation networks linking farms, ports, and cities in China. But the rise of the Chinese middle class is not just impacting domestic real estate. It's also having a profound impact on real estate markets across the region. The Chinese middle class is saving less and spending more. And they're not just spending on domestic goods, they're spending on imported goods as well. And this is transforming the nature of supply chains across the region and requiring a really large build out of fulfillment and logistics hubs to anchor this import demand. You know, places like Vietnam, Philippines, Indonesia, Korea, and Japan are all benefiting from this increasing import demand from the Chinese middle class. Another interesting trend, although it's currently curtailed by COVID, is the growing Chinese travel and tourism industry. The Asia Pacific hospitality sector has become a large beneficiary from all types of Chinese travel, whether it's business, leisure, retail tourism, medical tourism. And we expect this to be one of the fastest growing sectors coming out of the COVID recovery. And finally, while challenged by capital controls, we still see a very material amount of middle class wealth looking to be parked and invested offshore. Wealth management hubs like Hong Kong and Singapore are natural destinations and beneficiaries of this capital. And this has sparked a large dedicated wealth management industry set up to service the Chinese middle class. This translates to both the need for commercial real estate in those markets to house this wealth management industry, as well as all the professional service firms that support the industry. But it also creates the need to design and structure specific real estate products and structures that can meet the needs of this capital. So with that as I guess a very significant macro trend, let me now just touch on three thematics that we're seeing having a tremendous impact in both dislocating and disrupting many of the sectors across the region. Each of these three things, technology, COVID, and decarbonisation, are transforming real estate sectors in their own right. Technology is transforming the way we live, work, shop, play, interact. COVID is changing the nature of how we interact with each other and with our communities. But it's also putting a very, very sharp focus on health and wellness and sanitation and monitoring. And finally, with the real estate industry contributing about 40% of all the world's carbon emissions, climate change and decarbonisation is impacting all aspects of the real estate life cycle, from construction and design to development and operations. Together, these three themes pose very, very significant obsolescence risk for real estate across the region, but they also pose really interesting value opportunities. And I'd like to just share a couple of areas that we're focused on, and I'll use two specific sectors as examples, the office sector and the hospitality sector. But you could easily run this exercise for virtually every single real estate sector you could think of. So let me start with the office sector. Over the last 18 months, technology and COVID have fundamentally changed the way people think about office assets and about CBDs. At one end of the spectrum is the view that COVID and technology have rung the death knell for the office sector and for CBDs. As everyone can and wants to work from home, and no one needs or wants to come back to the office. We believe that view is misconstrued and is wrong. When we speak to the hundreds of office tenants that we have around the world, we feel that while there are certain functions that can be undertaken remotely, and there will become more flexibility in the way people work, the real fact is that companies live, breathe, and grow sustainably because of their people and their culture. And people need to physically interact, to exchange ideas, to foster culture, to mentor staff, and to develop skills and careers. So we don't believe the office sector is dead, far from it. We think there is an incredible opportunity to invest in transforming and owning office assets to make them post-COVID competitive. And let me just explain what I mean by post-COVID competitive. You see, what COVID and technology have really done is change the demands from office tenants. You know, as companies bring their staff back into the office, they need to provide their employees with much higher quality facilities. This includes things such as more space per person for social distancing. So it's really a reversal of the densification trends that we've seen in real estate over the last 2 decades. They need to provide their employees with better air quality, air filtration and sanitization systems. They need to provide their employees with more dynamic and powerful cleaning services, particularly in common areas like bathrooms and pantries and lift wells and meeting rooms. Employees and employers are demanding touchless access systems and inbuilt temperature screening, monitoring, and crowd control systems. And on the decarbonisation side, assets and real estate companies that are moving their assets down the decarbonisation path through using more green construction materials, particularly steel and cement, implementing more energy efficient lighting, distributed power generation, dynamic heating and cooling systems will drive much more value in their assets over the long term. These trends are going to create a significant bifurcation in the office sector. Those office assets and office asset owners who do not have the skills or the capital to transform their assets to make them post-COVID competitive are going to become obsolete very, very fast. On the other hand, those assets and owners who do have the skills and do invest the capital to transform their assets will outperform the market disproportionately over the long term. And this is where we see tremendous investment opportunities in the office sector across the region. The same thing can be said for the hospitality sector. Hospitality assets, as you all know, have been one of the hardest hit real estate sectors through COVID. Almost every single hotel around the world has had to close down for some period of time over the last 18 months. And when you shut down a hotel, the fixed costs are still very, very high. So that means that the capital structures of hotel assets around the world have been decimated. But technology and COVID are significantly transforming the way hotel assets are designed, built, and operated. For example, the implementation of digitizing check-in processes to make them more efficient and to limit physical contact during the check-in process. Implementing digital access keys and room keys not only creates touchless access systems throughout the hotels, but allows hotels to facilitate traffic flow and congestion throughout the hotel premises. Automating and enhancing cleaning and sanitization in rooms and common areas and entertainment areas throughout hotels. Changing the nature of the way F&B is delivered to guests across the hotels and enhancing business and event facilities to cater for more flexible work dynamics in and around hotels. So similar to the office sector, those hotel assets and owners that have the skills and capital to transform their hotels will disproportionately outperform the market over the next few years compared to those that don't, who significantly risk their hotel assets becoming obsolete. So in summary, while you can look at broad macro thematics, and while the Asian Pacific real estate markets will continue to be underpinned by trends such as the fast-growing Asian economies, urbanization, growing consumption, growing trade, as well as the institutionalization of the real estate and capital markets across the region. I hope this talk has just given you a few insights into some very specific macro trends and thematic trends that are disrupting and transforming our real estate sector in the region, and how we're looking at them both through a risk lens as well as through an opportunity lens. And with that, let me thank you all for your time, and I'd be delighted to discuss any of these topics in more detail with you or answer any other questions you may have. Thank you.
Great, Niel, thank you so much. That was very informative and insightful. Do we have any questions for Niel? Well, perhaps I can maybe just start off with one. And I guess, going forward, what would you see as some of the potential headwinds for the real estate market in Asia Pacific? The key ones, you believe?
Yeah, look, thanks, Eamon. Look, I think the biggest headwind is really the one I've just described, which is obsolescence risk. I think you can look at every single real estate sector in the region, and if the owner of that asset doesn't think about the impact of climate change and decarbonisation, if the owner of that asset doesn't think about how COVID is going to impact the way people interact with that asset, and how technology will need to be considered to make that asset more competitive going forward, they run the real risk of that asset becoming obsolete. So I think that's probably the biggest headwind, is not is taking all of that for granted and just assuming that your assets will be drawn along by the market. Look, I think the other risk is maybe the one I referred to right at the very start, which is assuming real estate is homogenous, and making a bet on a particular sector or a market just because that sector or the market is what everyone's talking about. So, to give you an example, most investors we talk to today love discussing industrial and logistics assets, because e-commerce and trade and consumption and the growing middle class is just driving the need for logistics assets and fulfillment centers. But there's a real risk that you simply just put money into the sector, as opposed to look at the fact that some logistics assets are going to do really well and other ones are not. And I think it's really important in any sector that you look at that you don't get caught up in painting all assets with the same brush. And that works the same way in reverse. If you look at something like the retail sector, and everyone thinks retail is dead, that Amazon and eBay are killing off all of retail assets around the world, then everyone oversells retail. But some retail assets are going to do really well and others are going to die. And so there really is a risk and an opportunity in painting all assets with the same brush.
Super, no, thanks, Neil. That's great. We have a couple of questions coming in. One of them is, what do you think the impact is geopolitically, regarding China's relations with, Australia particularly, and how will that impact real estate in Southeast Asia?
Yeah, look, it's a great question, and frankly, I'm not smart enough to be able to predict what's going on geopolitically, between Australia and China, or Australia and India, or how markets like Singapore are trying to balance their relations between China and the US. Look, what I would say is maybe the way we try and look at real estate is the majority of real estate you invest in is generally servicing local markets. For example, we bought a very large mixed-use office and retail portfolio in Shanghai at the beginning of last year. It was just newly built, fully vacant, but the focus was on the domestic catchment area for that asset. So whatever was going on with the Australia and China geopolitical discussions or between the US and China didn't really have an impact on what we were doing with that asset. And so I think, there are things you can predict, and there are things you can control. And when you can't predict or control things, sometimes it's better just to focus on the things and the investments where you feel comfortable you can control them. And I think that's why we tend to look at assets that really service the domestic markets, and we don't need to necessarily be as caught up in what goes on geopolitically.
Great, fantastic. Another question. When you're putting the things you talked about in the presentation, how do you ensure you have the right skills, etc., team members in place, operationally to execute on those themes, those thematic investment opportunities?
How do we ensure we have those skills?
Those skills you have.
Yeah, look, I think without trying to sound like I'm putting a sales pitch in, because I certainly don't want this to come across this way. I think Brookfield has been very lucky because our heritage over 100 years came from being an owner and operator of assets and businesses. And so, you know, we didn't come to these sectors from a financial or an investment banking background. We came to it from an owner and operating perspective. So we tend to only invest in assets and sectors where we have significant operating boots on the ground to fully operate and control those assets ourselves. And, you know, when we identify things where we need to supplement that, we oftentimes buy or build those capabilities internally before we deploy capital into the assets that require that sort of thing. You know, so we've built up. In fact, we incubated. Just to give you an example, we incubated a team in Silicon Valley about 4 years ago to understand how technology was disrupting the real asset sector. And we actually gave them a pool of capital to go and invest in VC and growth equity style startup companies that were investing in disrupting the real asset sectors so that we could get smarter around the types of technology that were flowing through to the types of assets that we invest in. So for us, it was tremendously important to become smart and deep in those sectors from an operating perspective.
Fantastic. Another question, probably just take a couple more questions, just given the time. You mentioned obviously 26 billion in Asia Pacific AUM. How much is specific to China? And what's your view on the risk level of property, or the property market in China currently, I guess, across the whole spectrum? And do you see, you know, going forward that sort of a significant shift of property investment into China, you know, based on the sort of dynamics that you're seeing?
Yeah, so we've added the 26 billion. I think we have about 4 billion of that in China. It's split between 3 sectors at the moment. So office, retail, and logistics and cold storage. So maybe you can split those two into 2 different sectors at the end. We are very strong bulls of China, and you know, real estate is clearly a long duration game. You know, there are investors that like to find pockets of dislocation and put their money in and pull their money out, and in markets like China, that's quite hard to do. But if you look at markets like China and India, you should be developing your strategies based on long-term fundamentals and trying to deploy your capital based on short-term opportunities. And when you look at China, the long-term fundamentals are fantastic. You know, the growing population, the urbanization, the growing middle class, the consumption, the trade, the advanced technology, the long-term fundamentals are really, really attractive. And then what you look at is where are there pockets where we have a competitive advantage, and that could be any different investor, but where do you naturally have a competitive advantage? So for example, we looked at the industrial logistics space, and when you try and look at a sector for opportunity, you look at 2 things: the fundamentals that are driving that opportunity and how much other capital is competing for it. Now in China, the fundamentals for logistics assets are incredible. But every single investor around the world is seeing the same thing, and so there's an enormous amount of capital looking for that, which makes the pricing quite challenging. So what we did is we looked at, well, is there a particular area within the logistics space that we think we could carve out a competitive advantage for us? And that's how we kind of ended up in the cold storage space, because we have, you know, a lot of experience around the world in retailing and in transportation and in shipping, and we thought we could combine that to just find that natural place. So, you know, I guess that's a long answer to your question, Eamon, but we think the long-term fundamentals in China are really attractive, which underpins long-term real estate growth. We think the market, the capital markets there are continuing to mature. We're starting to see more and more liberalisation of the real estate regulatory environment, as well as the capital market environment for both domestic and foreign capital. And all of that, I think, will translate to a more transparent, mature and attractive market over the long term.
Super. No, that's great. Thank you, Neil. I think just a very taxing presentation, and obviously the Q&A around. Maybe just finish with one question. I guess the question would be, if I can just pull this one up, hold on. From a Singapore context, we've seen, I guess, particularly HDB, perhaps condos as well. You've got prices, going up, maybe 40 plus times. Household income obviously hasn't gone up as much, substantially less, probably, 5 to 9 times. So how will this, particularly in Singapore context, if we're looking at a particular country, how will this impact real estate in Singapore? And generally for other markets that have similar dynamics, what can governments do to actually sort of balance things so, things don't become too onerous for people looking to buy a property?
Yeah, look, it's a fantastic question, Eamon. I'm certainly not an expert in Singapore housing economics and Singapore housing or Singapore housing government policy. But what I would say is, the Singapore government has a very long-term view around housing affordability, and they've been very forward-thinking for decades around ensuring that the Singapore population both can afford to own their own homes as well as can generate wealth off the back of home ownership. And if you look at any of their 20, 30, 40-year plans, it's all based on those two premises. And I'm not sure that's consistent across the region. I'm not sure there are that many governments across the region that have that sort of structured, forward-looking approach to their housing policies. Now, that's different, obviously, between that domestic public housing policy approach, as well as trying to manage foreign capital flowing in and pushing up the luxury residential space. And that's a whole different objective of, how you balance becoming a wealth management hub and attracting international companies, attracting international capital, but also keeping affordability balanced to that. So I think it's a really difficult thing for the Singapore government to try and find that balance. But I also don't see many other governments across the region as forward-thinking on their housing policies as Singapore is.
Super. Well, that's great. Well, Neil, thanks a million for today. We really appreciate your time. It was a great presentation, obviously answering the questions very eloquently. Thank you to everybody as well that's participated, taking time out of your busy schedules to sort of join us. There is a satisfaction poll that's available at the end. You can just give feedback, based on your thoughts about today. The other thing as well, just to remind you, I'm sorry that we couldn't answer all of your questions. The questions that were not answered, we will follow up with answers later on. But again, Neil, thank you so much for your time today. Thank you, everybody. And we hope to see you all again soon on a new topic shortly. All the best. Have a great day, and we'll speak soon. Thank you.
Very much.